Hey everyone, welcome back to Talk Tickers. You ready to dive deep into some earnings?
Always ready. Let's do it.
All right, so today we're breaking down Boeing's Q4 2024 earnings call. We've got a lot to cover.
Yeah, this one's going to be interesting. They're trying to bounce back in commercial aviation, but facing some major challenges on the defense side.
It's a tough balancing act for sure. So let's start with the big picture. Revenue for the quarter was $15.2 billion. That's a 31% drop year over year.
Ouch. Not great, but to be fair, the industry's still recovering from a few rough years.
True, but it still resulted in a core loss per share of $5.90. And free cash flow wasn't pretty either. They used $4.1 billion in cash this quarter.
Yeah, that negative free cash flow is definitely something to keep an eye on. It shows they're still burning through cash.
Okay, so let's break it down by segment, starting with commercial airplanes. The good news is the 737 MX production is back on track after that IAM strike.
That's huge. All 3 production lines are up and running in Renton. They delivered 36 737s in Q4, and they're planning to ramp up production to over 38 per month later in 2025.
So they're really pushing to get those MAXs out the door.
They have to. Airlines are hungry for new planes, but it's not just about building them, it's about making sure the suppliers can keep up.
Exactly. Like
Yeah.
you said before, it's a delicate dance.
And to make sure everyone's in sync, Boeing's using some pretty cool tech, like digital twin technology with key suppliers like Spirit Aerosystems.
Digital twin technology, that sounds futuristic.
It is. It's basically a virtual replica of the whole production process,
Yeah.
so they can track things in real time and spot any potential problems before they become major headaches.
That's smart. And they've also got those 6 key performance indicators or KPIs that they're tracking with the FAA.
Right. They're really focused on making sure the 737 production system is stable and safe. Things like employee proficiency and rework rates are all being closely monitored.
Makes sense. They need to rebuild trust after the MAX groundings.
Absolutely. Safety is paramount.
Wow.
Now, switching gears to the 787 Dreamliner production is increasing there too, but it's facing its own set of challenges.
Oh, what kind of challenges?
They're running into snags with seat certifications.
Seat certifications. Seriously?
It sounds trivial, but those things are more complex than you might think. Each seat is basically a mini monument with its own set of safety requirements.
So it's not just about slapping a seat in there and calling it a day.
Nope. They have to be rigorously tested and certified. But they're still aiming to hit a production rate of 7 Dreamliners per month sometime in 2025.
Ambitious, but hey, gotta aim high, right?
Exactly. And let's not forget about the 777X. Remember that?
The one that's been in development forever.
That's the one. Well, flight testing has resumed after some delays, and first delivery is still expected in 2026.
It's been a long road for the 777X. That program is super important for Boeing's future in the long-haul market. So fingers crossed they can stick to that timeline.
Agreed. Investors are definitely watching closely. Okay, so we talked about the good news on the commercial side. Now for the not-so-good news.
Yeah, let's talk about defense and space.
BDS booked $8 billion in new orders this quarter, which is pretty decent. But they also posted a $1.7 billion pre-tax charge.
Oof, that's gotta hurt. Where's that charge coming from?
Mainly cost overruns on fixed-price development programs, like the KC-46A tanker and the T-7A trainer.
Ah, fixed price contracts.
Yeah,
Those can be tricky.
they can. The idea is that you agree on a price up front, and that's it. But in reality, costs can fluctuate, and if they go up, the contractor usually ends up eating those overruns.
Yeah, it's like agreeing to bake a cake for $10, but then realizing the eggs cost way more than you thought.
Perfect analogy. And this isn't a new problem for the defense industry. Lockheed Martin had similar issues with the F-35 program.
So what's Boeing doing about it?
They're trying to work with the U.S. Air Force to actively manage these programs, which could include renegotiating some terms.
It's a tough spot to be in.
Yeah.
These programs are vital for national security, so there's a lot of pressure to deliver, but they also need to protect their bottom line.
Exactly. It's a delicate balancing act. And on top of the tanker and trainer programs, they're also dealing with losses on their F-15EX and FA-18 fighter jet programs, as well as some issues with their satellite programs.
So defense is definitely the problem child this quarter. It makes you wonder if they need to rethink their approach to fixed-price contracts altogether.
It's a valid question. Maybe they need to be more selective about the projects they take on or build in more safeguards to protect themselves from cost overruns.
Okay, so defense is a bit of a downer. Let's move on to something more positive. What about global services?
Global services. That's the steady workhorse. They delivered record operating margins in the quarter, driven by higher commercial air travel volume.
So as airlines get back on their feet, they need more maintenance and support services.
Right. And that's where global services comes in. It's a capital efficient, high margin business. It doesn't require massive investments to generate profit.
It's a nice counterbalance to the more capital-intensive manufacturing side of things.
Exactly. Global services provides a steady stream of revenue and helps to smooth out some of the volatility from the other segments.
It's like having a diversified portfolio. When one investment is down, another might be up.
That's a great way to put it. Now, even with the strength of global services, Boeing is still projecting negative free cash flow for 2025.
Yeah, we talked about that earlier. But it sounds like things are expected to improve in the second half of the year.
That's right. They're projecting to turn cash flow positive in the second half of 2025, setting the stage for a stronger 2026. This is largely because of the 737 and 787 production ramp up, closing down those expensive shadow factories, and of course, the continued strong performance of global services.
So even though the cash flow situation isn't ideal right now, there's light at the end of the tunnel.
Definitely. But they are planning to increase capital expenditures in 2025 to support this growth.
What does that mean exactly, capital expenditures?
CapEx is basically investments in things like new equipment, facilities, and technology. For Boeing, it could mean upgrading their factories, investing in research and development for new aircraft, or expanding their services capabilities. It's a sign that they're thinking long term.
Gotcha. Investing in the future. And speaking of long-term plans, they also completed a portfolio review and are considering streamlining some areas that may not be core to their business.
Right. It's not about a major restructuring or shedding a ton of jobs. It's more like pruning a tree, getting rid of the dead branches to help the healthy ones thrive.
So simplifying and optimizing. Makes sense.
Exactly. It's all part of this larger narrative of recovery and transformation that we're seeing unfold at Boeing.
Okay, so we've covered the financials, the segment performance, and those ongoing challenges. Before we move on, I want to remind everyone that this is just our analysis of Boeing's earnings call, and it's definitely not financial advice.
Right. We're just two aviation enthusiasts trying to make sense of the industry. Investing always carries risk, so do your own research and maybe even talk to a financial advisor before making any decisions.
Now, with that said, let's have some fun. It's time for our This Is Not Financial Advice segment, where we throw out a totally outrageous, but maybe plausible trade idea based on what we've learned.
Hit me with it.
So remember how we talked about those seat certifications being a bottleneck for the 787 Dreamliner?
Uh-huh.
What if we invest in a company that specializes in seat testing and certification?
Whoa, hold on there. You're talking about betting on the bottleneck itself.
Exactly. Think about it. As airlines ramp up their fleets, the demand for those services is going to skyrocket.
Yeah.
It's a niche market, but with high growth potential.
You might be onto something there. It's definitely risky, but if you can find the right company, there could be serious upside. But remember, folks, this is purely hypothetical. Do your research before investing in any company, especially one as specific as that.
Of course, we're just throwing ideas around. But it highlights the point that sometimes the most unexpected opportunities are hiding in plain sight.
Well said. All right, I think we've covered a lot of ground here. Let's move on to the next part of our deep dive, where we'll take a look at some listener questions and see what other insights we can glean from this earnings call.
Sounds good. Let's do it.
All right, so let's jump into some listener questions. We got some really good ones this time.
Okay, first up, we have a listener asking, with Airbus ramping up production, what's Boeing doing to claw back market share, especially in the narrow-body market?
Yeah. Airbus definitely took advantage of the whole 737 MAX situation. But the MAX is still a solid aircraft, and Boeing is pushing hard to increase production.
Right. We talked about that earlier.
Yeah. The key for them is to regain the trust of airlines and passengers. They also need to keep innovating. If they can develop new technologies that give them an edge over Airbus, that could be a game changer.
Like a comeback story.
Exactly. Now, another listener asked about the rumored 797 or whatever they're calling that new mid-market airplane.
Yeah, that one's been floating around for a while. What's the latest on that?
Well, the so-called 797 has been the talk of the industry for years. It's supposed to be this plane that fits between the 737 and the 787, targeting that middle-of-the-market demand.
Right.
Boeing has been dropping hints about it, but they haven't officially committed to a development program.
Probably playing it safe.
Yeah. There are a lot of factors to consider: market demand, development costs, and of course their financial situation. It's a big decision, and they're probably being extra cautious given everything else going on.
Understandable.
Yeah.
Okay, next question. This listener wants to know about the biggest risks facing Boeing going forward.
Ooh, good one. I'd say the risks fall into a few categories. First, there's still a lot of uncertainty in the supply chain. We've all seen how fragile it can be, and any more disruptions could throw their production plans off track.
Yeah, the supply chain is a big one.
Then there's those cost overruns on defense contracts. If they can't get those under control, it could really damage their reputation and bottom line.
And of course, there's always the competition from Airbus.
Oh yeah, Boeing can't afford to rest on their laurels. They have to keep innovating to stay ahead of the game.
Plus, there are geopolitical risks. Trade tensions,
Yeah.
political instability, all those things can impact global demand for airplanes.
It's a lot to manage.
And don't forget about the regulatory landscape.
Right, good point. The aviation industry is heavily regulated, and any changes in regulations, especially those related to safety or emissions, could have a big impact on Boeing's business.
True investors definitely need to pay attention to that.
Yeah.
Okay, so we've talked about the financials, the segment performance, the risks.
Hmm.
Before we move on to our fun segment, I want to circle back to global services for a minute.
Yeah, we touched on it earlier, but it's worth highlighting how important this segment is for Boeing right now.
It's really helping to stabilize the company during this turbulent period.
Exactly. Global services is this steady, profitable engine that just keeps chugging along.
And it shows that they're more than just an aircraft manufacturer.
Yeah.
They have this whole ecosystem of services to support airlines around the world.
Right. And as air travel continues to recover, that services business is only going to get stronger.
It's a smart strategy.
Hmm.
Diversifies their revenue streams and makes them less vulnerable to downturns in any one market. Okay, so now it's time for our totally outrageous, but maybe plausible trade idea of the day.
Hit me with it.
All right, so remember how we talked about those seat certifications being a bottleneck for the 787 Dreamliner?
Yeah.
What if we invest in a company that specializes in seat testing and certification?
Interesting. You're thinking as airlines ramp up their fleets, the demand for those services will increase.
Exactly. It's a niche market, but with high growth potential.
Risky, but if you can find the right company, there could be some serious upside. But remember, everyone, this is just a fun thought experiment. Do your research before investing in any company.
Of course. We're just throwing ideas out there.
Right, but it does show that sometimes the most unexpected opportunities are hiding in plain sight.
Exactly. All right, I think we've covered a lot of ground here. Let's wrap up this deep dive by summarizing the key takeaways and leave our listeners with some final thoughts to ponder. Okay, so it's time to wrap up our deep dive into Boeing's Q4 2024 earnings call. We've gone over a lot.
We sure have. It's a complex picture with lots of moving parts.
Absolutely. So let's summarize what we've learned. First off, Boeing's commercial airplane business is showing some positive signs.
Yeah, that 737 MAX is back in production. And they're increasing production of the 77 Dreamliner.
But they're still dealing with those supply chain issues and those seat certifications.
Right, those are definitely headwinds. But the 777X is still on track for delivery in 2026.
Which is great news for Boeing's long-haul ambitions.
Exactly. Now, on the flip side, those defense contracts continue to be a problem.
Yeah, those cost overruns are really eating into their profits.
It raises questions about their risk management strategies.
For sure. But at least Global Services is performing well.
Yeah.
It's a bright spot in their portfolio.
Definitely. It's a stable, profitable business that's helping to offset some of those defense struggles,
And they're projecting to turn cash flow positive in the second half of 2025.
which is a key milestone in their recovery.
Absolutely. And they're also planning to increase capital expenditures in 2025.
A sign that they're investing in the future.
Right. And they're also looking at streamlining their portfolio to focus on their core strengths.
So overall, there are definitely challenges ahead for Boeing, but there are also signs of progress and a commitment to turning things around.
It'll be interesting to see what happens next.
Agreed. Well, I think we've given our listeners a lot to think about.
We sure have. As always, we encourage everyone to do their own research and stay informed. But before we sign off, let's leave everyone with one final thought.
Okay, shoot.
We talked about Boeing's portfolio review. What if they decide to spin off Global Services into a separate publicly traded company?
That would be a major move. It could unlock value for shareholders and allow Global Services to grow independently.
But it would also mean losing that steady stream of revenue and that buffer against volatility.
It's a tough call. There's a lot to consider.
Definitely. Something to keep an eye on in the future.
Absolutely. Well, folks, that wraps up our deep dive into Boeing's Q4 2024 earnings call.
Thanks for joining us. And we'll catch you on the next episode of Talk Tickers.